With a huge surge in interest rates, why hasn't the Canadian housing market collapsed in 2023? Let me give you a little insight. Well, Canadian housing prices should likely have dropped more in 2023, but they have not. Big banks are helping to stop the sharp correction, and here is how. If you're a Canadian looking at buying or selling a house or set to renew your mortgage, you need to watch this. Unless you've been living under a rock over the past year, maybe you have. You should be very aware of the sharp rise in interest rates and the resulting resetting of mortgage rates from historic lows at a historically high pace. For Canadian homeowners or prospective buyers, rates have jumped from 1 to 2.5% to 5 to 7% in some cases. That is in the area of 150 to 250% increase, a shocking jump in such a short period of time. The increase should be crushing household budgets and should have led to a sharp drop in the housing market, but it has not. In fact, while many other asset classes, including tech stocks, crypto, and energy, have dropped 30 to 50%, Canadian housing prices have seen a relatively modest 15% decline on average, despite surging 50% post-pandemic. Why, you ask? The big banks have a dirty little secret, which has significantly altered their mortgage books over the past year. While it may not be sustainable and is not in your best interest as a mortgage holder, pun intended, terrible pun, it is the financial industry's secret to Canada's remarkably low delinquencies despite soaring interest rates. This has been hugely underreported, even in financial circles. Most Canadians are basically unaware it is even happening, and it has really just begun over the past year. Under the pretense of helping Canadians afford their homes, the big banks are extending your mortgage, supersizing them, if you will, from 20 to 25 years to 30 to 35 years or greater. Kids, these are not your parents' mortgages, but they may be your kids because you may never pay them off. And who says you're not leaving them anything substantial? Here you are, kids, have my debt. If you think I'm making this up, look no further than the big bank's most recent filings. First, we look at CIBC's financial statements because who doesn't like to do that in their free time? Fortunately, we've done it for you. Look at this. 1 year prior to this filing, 0% of their Canadian mortgages were greater than 35 years. Today, 26% are greater than 35 years. Similar case with Royal Bank. If we look here, 1 year prior to the filings, 0% of their Canadian mortgages were greater than 35 years. Fast forward to today, 25% are greater than 35 years. And finally, TD. Here you look at the filings prior to this 1 year, 0% of their Canadian mortgages were greater than 35 years. Today, similarly, 25.2% are greater than 35 years. Now, the key here really is assessing the impact for Canadians who have been choosing to extend their mortgages, or if you're going to do it in the future. Let me give you two examples. First, a $500,000 principal mortgage at 4.5% interest rate, your rate could be higher. Now, 25 years versus extending the mortgage to 40 years. This will give you a good idea of what choice you're making when you extend the mortgage and what it costs you. The first row is the monthly payments, interest and principal. The second row is the percentage that your interest payment is of the total monthly payment. The third row is the percentage your principal payment is of the total monthly payment. The final row is the total interest paid over the life of the mortgage. Here we can see that when you choose to extend the amortization period from 25 to 40 years, you have increased the interest you are paying from $333,000 to $578,000. That's $245,000 more by extending. That is the interest cost to you. 73% more interest you will potentially be paying if you agree to this. Yes, your monthly payment was reduced $531 from $2,779 to $2,247. But there is a massive long-term cost, and that is potentially $245,000 in additional interest. Let's quickly look at the numbers on a $1 million mortgage. Same chart, same comparison on extending the amortization period from 25 to 40 years. Again, you've reduced your payment, which is the short-term goal, from $5,558 to $4,495, saving you roughly $1,063 per month. But the long-term cost is massive. In this case, you increase the interest that you're paying from $667,000 to roughly $1.16 million. That's $490,000 more by extending your mortgage. 73% more interest, because that's how math works. In the short term, the extension may serve its purpose, as you do not have to panic sell your house. I get it. But perhaps it is time you have the tough conversation you should have had with yourself 2 to 4 to 5 years ago when you bought a house that you really could not afford. I know them's fighting words in most parts. Or at least start to seek out outside advice from someone other than the big banks who told you that rates will never go higher and you can definitely afford this home at such a low variable rate, with no eye to what could happen if the rates did increase. No one wants to hear this because it sucks. Hard decisions may have to be made, but they could prevent far worse circumstances down the road. One option would be to consider moving farther away from your current area. I know the area your kids are going to school or are going to go to school. Again, that's tough. But if you move to an area you can reasonably afford while prices are still relatively high, it could save you hundreds of thousands of dollars and get you out of a 35 to 40-year mortgage that seemingly never ends. If you bought pre-pandemic or even at the start of the pandemic, you likely remain well ahead in terms of house value and prevent yourself from a worse situation 2+ years down the road if housing prices do eventually drop significantly. Now, that is a conversation every Canadian should be having with themselves. Take responsibility for your financial future. Stop relying on the big banks for all of your advice. Remember, the banks now helping you extend your mortgage to 35+ years were the same ones who give you the terrible advice to continue with a variable rate just so you could qualify to buy a slightly larger house without locking in your terms. This was terrible advice. Extending your mortgage amortization by 10 to 15 to 20 years can also basically be doubling down on a poor decision. At the very least, every Canadian who is contemplating this strategy should look at the 2 slides we put together above, illustrating the hundreds of thousands in extra interest that house could cost them if they continue to under those existing terms. Sure, the banks will tell them the extension could be only temporary. Where your current 3 to 5 year term is up, you can go back to your original 20 to 25 or 30-year mortgage and hope that the interest rate will be lower and you can get a better rate. Now, this assumes that rates will be lower at that time, a guess at best, and while rates have risen substantially, they remain below historical averages because the low rates from 1 to 2 years ago were historically low rates. The odds of going back to these historically low rates in the 1.5% to 2.5% range that every Canadian should have been told to lock in at is low. That's why they're called historically low. So what should you do? Again, take some responsibility. As I said, stop blindly listening to big bank advice. Some offer sound advice, but many, quite frankly, have been giving terrible advice to homeowners. Start taking higher stake in your own financial well-being, be it with your home purchase or with your investments, an area we have been helping independent-minded Canadians with for over 2 decades. On the home front, stop trying to keep up with the Joneses, perhaps, at every turn. Perhaps a little less house is good. Or God forbid you'll have to do as most of your and my parents did, even your grandparents did, move a little farther away from the city core than you originally wanted. Pay a little less. Leave some buffer capital on the table for a rainy day. And when rates are at historical low rates, lock in for 5+ years. We put this video together to show you the real cost of extending your mortgage, as it appears hundreds of thousands to even millions of Canadians are already doing so or about to make the same decision. Look at the real numbers and see if it makes sense for you and your family long term. Perhaps you will make some tough decisions. Don't continue lying to yourself just because it is easy. Well, let me know your thoughts and comments on this video and what we're saying here. As always, I wish you profitable investing. Thank you.